Most business owners think private equity is scary. And if that's your first reaction, it's usually because you're still thinking like an operator. Today's deal of the week is the University of Utah private equity deal with Otro Capital. Now, I'm not breaking this down because I want to debate college sports with you. There are already plenty of loud opinions about this very deal. But what I'm talking about is how can we learn from Otro Capital on how to actually make this work for us? I'm looking at this like it's a case study in how investors think. Because if you're running a 7 or 8 figure business, this is the way of thinking that you're often missing. Most business owners will run a company for decades. They make great money, they take care of their family, they build a nice life, but the business never actually becomes a sellable asset. It's never something that they can actually cash in on. So they miss the real upside. It's just income, not enterprise value. And what separates the owners who walk into an exit from the owners who sell with like just predictability is usually this. They build the company like an asset from the beginning. They build it to be transferable from the beginning. And that's what I want you to learn from this Otro Capital deal. So here's what happened. The University of Utah didn't sell their athletic department. What they did is they carved out the commercial engine around athletics, the brand, the monetization, into a for-profit entity. And then they brought in Otro Capital as a minority partner to help operate that entity. Now, the details really matter here because the details show you how Otro believes. It's how they think that I want you to get out of this. So why would they do this? Why would a private equity firm do this? Because they're seeing this as a way to grow and expand their capital. They're thinking completely different. And the thing is once you start thinking how they think, you can apply that same logic and those same ideas to the way that you run your business. Investors don't just buy things to buy things. They're not just doing something because it feels or sounds good. They buy things for 3 reasons. Number 1 is more cash flow. Number 2 is they want to get into a new market. And number 3 is they want a new capability. So why would Otro Capital do this deal with the University of Utah? It's not because they love the University of Utah. It's because they believe that college athletics and university brands are becoming an investable asset class. In other words, it's a new market for the private equity firm. So they believe that they can better monetize this product than the University of Utah can. And of course, they do want payout. Private equity fund, the world doesn't go around, unless someone's getting paid to operate things, the world doesn't go around in a freeness. So of course they want cash flow. But the primary reason is they want a new market. They want to bring their capability to the University of Utah to help make that payout actually happen. The reporting around this deal has it on a 5 to 7 year window. So essentially is what Otro is doing. They're looking at this and they're thinking, we can use our operating playbook. We can grow and tighten their commercial engine. We can create a more valuable asset in that 5 to 7 year time frame. That is how investors think. They're thinking around asset value, not income value. See, most business owners are thinking business. They see marketing and sales and operations and payroll and customers. Otro is looking at this like they're the asset manager because that's who they are. How do we protect the value of this asset? How do we increase the value of this asset? What levers matter? What levers don't? They're looking at distribution, partnerships, pricing power, the licensing, the media rights, the brand value, the demand, the attention, and they're looking to create predictability from their past experience of what they have brought to the table before. If your business isn't sellable, and you can still have great income, it doesn't mean you're not making good money. But if it's not sellable, it's really not an asset. And so most founders are great at the making of money, but they're not great at the building of wealth. When you start thinking like an owner investor, you're actually shifting from I'm focused on the income to I'm focused on the asset value. Here are 3 things that you can do to start thinking like an investor today. Number 1, you need to separate the commercial engine. So stop blending everything together and everything's just the business. Start to separate things out. And here's what I mean by that. You're going to break into parts. So the delivery gets broken out, the marketing gets broken out, the sales gets broken out, retention, partnerships, IP, licensing, brand, the data, and the distribution. You should be able to draw a straight line from each of those things that you break out to how does that thing help us become more profitable? How does this thing help us increase the valuation? How does doing X, Y, and Z actually contribute to the asset value? But if it's all just the business, you can't draw straight lines to different things and how it actually helps the value. The second thing you do is build a system that's not dependent on you. Otro isn't doing this deal with the University of Utah because one person's going to show up and do everything personally for operations. They have a team, they have a process, they have a playbook, they have capabilities that can be applied here. That's something that you can mirror. You might have to ask yourself a painful question. If you disappeared for 60 or 90 days, what happens to your revenue? What happens to your profitability? What happens to your business? Because whatever is breaking, whatever's not working, means that you don't have a system that can be imprinted somewhere else. Otro has that system. They have that dialed in, and that's one of the ways that they're able to come in and actually be a great operator. The third thing you can do is stop chasing growth just because it feels good. So many business owners are so focused on, I'm a 7-figure revenue business, when they have no profitability. I'm an 8-figure revenue business. We did X amount of dollars in a day. That's what they love to talk about, not the actual stuff that matters. Owner operators chase revenue. Owner investors chase valuation outcomes. That means you think in portfolio terms. How do I protect the value of this asset? How do I increase the value of this asset? How do I reduce the risk that would scare off a buyer or force them to sell it at a discount? And this is where people get really confused. They call private equity risky. But here's the truth. And I don't want you to think private equity is thinking like an investors. I don't want us to just become private equity. I want us to think like investors. And so many people think that that way of thinking is risky. But here's the truth. Everything is a risk. Every investment, everything we do, staying the same in your business is a risk. Not being aware of potential disruptions is a risk. Everything is a risk. The risk is in you as the investor, not in the investment. And when you choose to not behave and think like an investor, you're choosing a path that leads to success very rarely. Does it happen? Yes, it does. But is it probable? Not really. 80% of business owners don't sell. 80 to 90% of most business owners' net worth is tied up in that unsellable business. Most don't sell. Most of your net worth is in it. That is a risky proposition. So it's not about risk. It's about learning how to think like an investor, start behaving like an investor so that you can de-risk the risk so that it's less risky for you rather than someone that is right fresh off the street. And that's why I have the deal of the week. That's why we're talking about this, is so that you can start your mindset shift to thinking like an investor today instead of just going on with the path that may end well for you, but for the majority of business owners, doesn't end having them hit their biggest aspirations. When you start operating like an owner investor, 3 things happen. Number 1, your business becomes the strongest asset in your portfolio. Number 2, you get flexibility. You can sell the business or you can keep it. It's a cash flow machine. You have choices because you've chosen to think this way. And then number 3, because you have stronger cash flow, predictability, the valuation of your business is going up, you now have more cash to allocate to assets outside of your business, further de-risking your wealth. You're creating a compounding effect on the wealth inside your business and on the wealth outside your business. Here's my challenge to you. Instead of asking, how do I improve sales or marketing? Start asking, how do I make my business more attractive, more asset-like, more viable for someone else to own and run? Because that's one of the major differences between those that are just good at making money and those that are actually building generational wealth. Otro Capital and the University of Utah did something that's never happened before, but they both see the upside. But from Otro Capital's side of this, they're looking at it from new market. Our capability in that new market is going to produce X return in a 7 to 6 year period. And when you can get to that level of confidence as a business owner, you've transitioned from the owner operator to the owner investor. I'm Justin D. Maxwell, and thanks for watching.